Creamer Media's Mining Weekly Online is talking to Neil Pretorius, the CEO of DRDGold. Neil, all the arrows are pointing up. Great leverage to the gold price. Dividends up, free cash flow.
It's probably our hedging strategy that came through the strongest this year, because we don't hedge. And the gold price is up significantly. First, as a result of some of the events in December, which saw the rand lose quite a bit of ground against international currencies. And then, of course, the Brits did us an enormous favor when they decided that they no longer want to be part of the European Union. The market has retreated off those highs, and it's back to, I think some of the analysts are saying, fundamental support lies for the business. We do respond to movements in the gold price quite sharply. These stocks are, I think, are the domain of professionals, because you've got to understand what the dynamics are that drive the gold price, and also that ultimately drive gold shares. And ours is very steeply geared to movements in the gold price. If the gold price goes down, we know what happens to our stock when the gold price goes down.
And just tell us about your share. It's been an incredible story, rising so dramatically from about 700 million in October last year.
The market cap is just over 3.8 billion rand at the moment. So we added 3 billion to the market cap in the last few months. The business has been a fairly steady performer. There was a good surprise in March. We had a very good production run in March. We came off a very, very low base. So there was much more room for us, and I think we increased 400 or 500% at one stage. Hopefully there is fundamental support for the share price at these levels. Hopefully we can sustain it. We've been delivering value, I think, to our employees, to many of our stakeholders, to surrounding communities and so forth. The shareholders have been left in the cold for a long, long time, so it's satisfying to see that the shareholders got some value in the last 12 months. The free cash flow was up 25%, and I think that number was 308 million. Out of that 308 million, roughly 260 million is finding its way into the pockets of our shareholders by way of dividends. It's going to be tough to beat this. It was an exceptionally good year. We had the benefit of some tail-end high-grade throughput at nights, and we had the added benefit of a gold price that came from nowhere and just shot the lights out. I think it turned at somewhere 650,000 rand a kilo at one stage, if I'm not mistaken. So a tough act to follow, but I think the message into the market has been consistent. If there's free cash flow, it'll be distributed. If there isn't, then there won't. And our endeavor remains to remain profitable and to generate as much free cash flow consistently through the optimal exploitation of our ore body. We are focusing a lot on bringing dust exceedances down off our tailings dams. You do that by way of vegetating those tailings dams. A lot of money goes into that. Despite the dividend payment of this year, and despite having paid dividends in the last 9 years, the money spent on this particular aspect of the business still exceeds the total return and dividend to shareholders. So I think if money spent is an indication of where your priorities lie, or at least your awareness of what needs to happen in order to be sustainable, that number is indicative of that. We are striving towards establishing a knowledge-based labor force. It's the lowest risk type, we believe, and we're seeing that. Our employees have rewarded us this year by agreeing without any disruption to operations to another 2-year wage agreement with additional benefits. I choose to believe that some of those benefits which have been included in that wage agreement are long overdue. It involves a housing scheme in terms of which assistance is provided by way of top-up finance to make home ownership a real possibility for those of our employees who don't have that security of tenure. Our community projects categorize those basically in 2 main categories. It's youth education and poverty alleviation. And the person that you're seeing there, if I may just digress a little bit, that's a vegetable garden, one of the informal settlements not far from our operations. And plan's been devised and it's put in place where on a piece of land the size of a door you can feed a family of 4. And this has taken off wonderfully. More than 500 families have already taken this up. Some of those are now also green shooting out and becoming entrepreneurs, becoming bona fide vegetable farmers. For the next 6-7 months through to January, maybe early February, there will be some cleanup done at the West Rand site. That will continue to put pressure on the costs of material being fed into that before we hit the site that's been developed in just south of Johannesburg, and we're going to hit that really hard. Spend a lot of capital to put a decent site in place there for decent volume throughput, and those are going to be cheap tons to mine. The work that we've done at night towards maintenance, we should see the effects of that going forward as well. Come December, we should have a pretty good picture as to what the future will look like production-wise. We're not adjusting our production target just yet. I think we do say to the market that we want to produce between 145 and 150,000 ounces per year. At this stage, I think we're probably going to be threatening the lower end of that range as opposed to the higher end. But we'll know come December how things pan out, and also how successfully we commission the new site in January/February. But if you're confident that the gold price will continue to go up, and it should, because I think there's just too much paper value out there, not real value, then hopefully we'll see more of these cycles going forward.
Meanwhile, the dividend is very good. It's gone from 10 cents to 62 cents.
Once again, I think that's a testament to our hedging strategy. Our hedging strategy is we don't hedge, so if the gold price is going to go up, we can take full advantage because we calculate our costs. We work towards costs supported by the gold price at the time.
Finally, technically, you seem to have put yourself into a solid position.
There are a number of things that are going well for us, but there are also some niggling issues. We are in a cleanup phase in the far West Rand, and that is adding quite a bit of drag to our unit costs per kilo, because those are expensive tons. And we have another site waiting to be mined, but we're not going to pull out until that site's been cleaned up. And that's going to be until about January or February of next year before we can hit the new site, which will be cheaper tons going into the circuit, slightly lower grades, but much cheaper tons. And then we've also been doing quite a bit of maintenance at one of our high-grade circuits at night. And that impacted on the numbers towards the end of the year. Hopefully going into the new year, we'll saw better stability off the back of the maintenance changes that we've made and engineering changes that we've made there. So yeah, I think lots going well for the business, but it's not entirely risk-free. You still got to keep your eyes on the dials.
That was Creamer Media's Mining Weekly Online, talking to Neil Pretorius, the CEO of DRDGold.